Welcome, everyone. I'm Rebecca Wallenfelsz, a partner in the Trust and Estates Group at Chapman Partner. With me today is Mike Jankowske, who is president of the Hamelind Group. Mike provides plan-giving resources and strategies to professional advisors, donors, and non-for-profits as part of the Hamelind Group. Prior to starting the Hamelind Group, Mike was a financial planner who spent about the last 30 years helping clients rethink their assets and their investments through a tax lens, which of course always speaks to me. And with that, Mike does that through a strategy he calls tax diversification. So that is sitting down with clients and having them think through their assets, their net worth, through a tax lens and giving them a tax characteristic. And Mike and I have been doing a series of videos where we talk about the different tax categories. And today we're going to be talking about an exciting one. So first of all, Mike, welcome.
Welcome, everybody. Thanks, Rebecca.
And today we're going to be talking about, I think, Mike, your favorite tax category?
Well, as I can aptly put, if you look at the gleam in both of our eyes, it's rather obvious we're going to be excited. We hope you're going to be excited out there about what we're going to talk about.
Yeah, and really this tax category, we're referring to tax credit and strategies and tax shelters, right? You call this category, Mike, tax shelters.
Yes.
Right, but it's not tax shelters as some people normally think about it, although it can be, and that is where I put my assets in an investment that may reduce taxes, maybe usually through the production of maybe losses. But really, it's thinking through someone's assets and income and priorities in life and coming up with finding tax credits and ways and strategies to offset tax liability. That's really what we're talking about when we talk about tax shelters. So, Mike, with that, how would you define this category?
I know you have an emphasis in your brain right now about tax credits, and that's fine. In the perfect world, we have a tax credit for whatever we do. But the category for tax sheltered is a hybrid, and the best way to describe it is there could be assets that shift from other categories into this particular category / bucket. It could also be something where we're realigning assets in another bucket to allow us the ability to reduce the tax liability in a year where we're trying to transition money from an IRA to a Roth, sell a business or piece of real estate, et cetera, et cetera. So it's critically important to know the components of this particular tax bucket or category, and having the ability to know that you can do something in anticipation of. And I'm going to define what anticipation is in terms of timing on this. But this is a hybrid. This is something where you're going to have assets moving in, assets realigned elsewhere. You might be somewhat confused about the other category we're going to talk about in the next session, which is trusts. There's some play in here. I don't want to confuse the issue for what we would consider trust planning over on the trust piece of it. Suffice to say, it's a hybrid. And what's important is, in the year that you make a move to sell or convert, what can we do to offset the taxation in that particular year?
Yeah, and a lot of that, and it can be maybe even in a standard tax year, but it becomes even more important, right? In a year where I have an unusual taxable event, a conversion of a traditional IRA to a Roth, the sale of a business, the sale of a significant piece of real estate where I have a high capital gain, perhaps.
Well, interestingly enough, that's a definition that deals with what I call tax reacting. It's almost like you do something, and what happens is you got 12 months or less, maybe even no time, to talk to your friendly financial advisor, CPA, or the estate planning income tax planning attorney about what can I do with this I just did, or I have a limited amount of time for you to give me advice. The key for this is anticipation is not within 12-month period. It is probably the more you can learn about what you can do in this particular category, and in terms of years of having things teed up, ready to go to make a change and just modify what you're likely to do as the law changes or your circumstances can change. That is the ideal set of circumstances where we get the optimal savings, as part of the tax strategy bucket.
Yeah, and that's good to know too, right? Because the idea conceptually is if I'm waiting until I've decided to sell something, for example, or I've decided to convert, and then I'm coming and looking for my tax shelter, I may have fewer options than if years earlier I thought about what the possibilities might be, including a sale or recognition event, and I might be able to set up other assets and resources so that in that year of that event, I'm set up for minimizing that tax impact.
And as we explain more of these strategies in this session, it's going to become more clear. The more you have an understanding of what you can do, it's better. And plus, sometimes it's not the person that's going to be driving the bus in terms of, well, we're going to sell a business. It could be that somebody makes you an offer you can't refuse. Okay. And then what's going to happen is suddenly you on red alert with your advisors to figure that out. But I will say this, assessing ahead of time, years ahead of time, in a way where you can see the benefits and staying on top of the understanding in collaboration with all the professionals is critical to this category, which we're going to break down now. All right.
Yeah.
Are you going to ask me what things we're going to be talking about in this category?
Yes. So let's start. Go ahead.
No, I know Rebecca is so excited about this. She can't hide it. She's about to lose control, but I think I like it. But the bottom line is here are three things that you can think about in this particular category. I call it a category within a category. And what we are going to be talking about is in a year, okay, that something happens. What the first thing that comes to mind is how do we reduce income that you normally show in the year? So it's a reduction of income. Yep. The second piece that's a category in a category is what tax deductions can I take? Okay. And the third category within a category is what tax credits are available to me in the year I'm willing to do, or this is happening to me. So we're going to bundle each one of those categories within the categories. So, yeah.
So let's talk about that first one.
Right. Rebecca can't wait. Okay. So the bottom line is reducing income. And this is all about timing. Because, for example, if you want to reduce income and you're talking December 1st of the year that you're trying to do it, guess what? There's very little impact of what you're doing there. So the more you can be proactive and do something to reduce your income in the beginning of the year versus later is better. I'll give you a couple of different examples based on actual stories. Okay. We have back before they allowed anybody to do a Roth conversion. When the Roth first came out, you had to be below $100,000 of modified adjusted gross income, even to do a Roth conversion. So imagine that you'd have to find a way to qualify to do a Roth conversion, much less counteract the taxes on the conversion, like we're talking about here. So I remember one story clearly. We were brainstorming with a client in a meeting. They were about $5,000 to $7,000 over the $100,000. We looked at everything we could do, and the client, with the other person I was working with, gave us the answer. The client said, well, what if I stopped taking Social Security? Because I'm being taxed on Social Security. What if I stopped it for 3 months or 6 months? Can I do that? And we called up our wonderful Social Security Administration, and we got the whole story. Well, if you're before age 70 and a half, you can stop and defer and get more benefit. You'll catch up, or you just stop it and lose the number of months you lose. But in either way, when you run the numbers, it was better off not to take the income.
Yep.
To qualify to do the conversion, counteract the taxes to begin with, because in the long haul, what you might have lost in income streams, you well overcompensated what you got tax-free from a Roth conversion. Another example of how you reduce income is if you work for an employer where you've got some ability to play and the employer's innovative with you, you can set up a, for lack of a better description, a deferred compensation. You could say, you know what, I'm not going to want to take some of this income. Can you write a contract where I won't take income for a year or 6 months, and then we'll turn around and you can pay me next year? Mm-hmm. That type of thing. So those are examples of reducing income. There's a lot more than that, but for purposes of not making this session 5 hours, that gives the juices going for what you have to do. But remember, you can't sit down with your employer in June or July or December and try to reduce your income for the year. You have to pose to the employer, or if it's your own business, you can tell yourself to work on this in January or even prior to January, so you have the ability to be able to do this. So that's the key to this, because it's integrated all together. And again, if you can drop your income for a year by $100,000, that's $100,000 of Roth conversion. that's 100,000, more than 100,000 based on your tax bracket, that you can counteract a capital gain, because if your marginal tax rate is larger than your capital gain rate, you basically can create more tax-free status of a sale on a capital gain, because the reduction of income saves you taxes at a higher marginal rate. So all those kind of little tricks are very specific to a person that is looking at this, and even more reason why it's proactive and has to be thought out years ahead of time and reassessed once a year, for lack of a better description, to see what has tweaked or changed.
Yeah, that's great. Yeah, and especially these days with so many different tax rate rules, such as like the net investment income tax that applies if your modified adjusted gross income is above a certain level. There's an additional layer of tax that you're subject to in a year where when you have unusually high income, and finding ways to lower that can reduce your exposure to that additional tax.
Oh, and there's all kinds of, nuances to this. And like I said, if we're pushing 5 hours in this session, we offer for apologies right now to the viewers, but I would dare say that pretty much epitomizes the first category within a category. The second category within a category, unless Rebecca has some questions about the first category.
Nope.
Okay. And if viewers have questions, feel free to contact Rebecca, or any way she can get a hold of me afterwards about this particular session. The second category is tax deductions. Now, Rebecca immediately gravitated to tax credits because her brain says, I want a tax reduction, dollar for dollar versus a tax deduction. The tax deductions are a big key here. One other caveat back to the income. Sometimes what you could do in a year where you're trying to reduce income, if you have investment portfolios that throw off dividends or interest, perhaps part of what you're going to be doing, and you're better off doing it, is to reduce the amount of interest or dividends you would have to report. Maybe you go to more tax exempts. There could be a bunch of things you can do to take the interest or dividends out of the picture, as part of that first category in a category. I apologize profusely for forgetting that. And Rebecca normally reminded me, so she's too excited about tax credits. So tax deductions. Tax deductions are the bread of life for people who are CPAs and or financial advisors, and even some friendly attorneys who are start to realize that income tax planning is just as important, if not more so, than estate planning taxation. So the bottom line is, what do we mean by deductions? I'll give a couple simple examples, okay? You can take money from an IRA, you flip it over to a Roth, you have a portion of cardiac arrest when you look at what that income tax liability is going to be. But then let's say you find a way by creating deductions where you would counteract 40 to 50% of the reportable income on that conversion. And one really clean way of being able to do that is to create a donor advised fund, or if you have one already, you contribute to a donor advised fund. And then when you run the numbers, believe it or not, all you're doing is you're transforming what you would have paid in what I call involuntary philanthropy in federal taxes into voluntary philanthropy, and you have more wealth. That's more tax favored if you want to use it for yourself or the next generation. So a donor advised fund is something that would be considered part of the tax strategy that we talk about bucket, so that you could have a donor advised fund and sitting inside of there that can really do all kinds of cool stuff with regards to creating that deduction. That's typically important when you're dealing with Roth conversions. It can have play for selling a business or a piece of real estate, because the next thing I'm going to talk about within this category, within the category for deductions, are charitable trusts. But sometimes you're limited to how much of the charitable deduction you're going to create from a charitable trust. And a donor advised fund allows you freedom to create more tax deductibility on the charitable side in a marriage between the donor advised fund and charitable trusts. Which brings me to the charitable trust. You can transform taxation, kick the can down the road for taxation at lower rates by creating a form of charitable trust. And the perfect example for a business or a piece of real estate is what I call the installment sale version of a charitable trust, a term trust. What you do is you take a percentage of the real estate or business, you transfer the title to a charitable trust, all right, you sell it, okay, and the portion you don't put in the trust itself creates a charitable deduction to counteract most, if not all, the taxes from the lump sum you get. And then for 10 years or 15 years, for example, you get a cash flow, which is comprised of capital gain, treated income, some interest. And then if you look at the numbers, typically speaking, you have so much more cash flow and net money left over after the period of term for that charitable trust. And then imagine the fact that you've got free and clear cash with regards to that. One other thing that real estate people and business owners love is they like doing things like, I want to buy more businesses. I want to buy more real estate. And my argument would be, well, sell some of that stuff off. Don't use this thing called a 1031 exchange, which is under some question. Why not leverage more money to get the real estate you want and get some benefits from a tax perspective, and let the game plan for what you've done to counteract the taxes for one holding you got rid of or multiple holdings stand pat, and you'll be better off financially if you run the numbers. Okay, that is some examples of tax deductions. Okay, now it sounds like I'm talking about you have to give away all your money, but in concept, from a wealth management perspective, the numbers show quite clearly all you're doing is transforming money you pay taxes on into something where you can use for the social good, and you have more money out of the gig, which is kind of cool. Now, there are other tax deductions. We don't have enough time in the video. That's another 3-hour video of how you generate tax deductions. But in my space, this is awesome because most people who see this generally have what I call philanthropy at heart, except they hate the two words charitable intent because they think they got to make sacrificial gifts, and therefore they're thinking about subtracting from their wealth as opposed to enhancing their wealth. That's critically important for somebody to have an understanding with in this type of concept.
Yeah, and that's where running the numbers really, really does help, because they really help illustrate.
Yeah, in collaboration with your favorite attorney, favorite CPA, favorite financial advisor, or some guy like me that can come in and help consult on this type of stuff. Okay, so it's pretty cool. The third category within the category is what Rebecca kept repeating over and over again in the beginning, which is tax credits. Yeah. Now, do you want to define what a tax credit is, Rebecca? You're dying to say something.
Yeah, so a tax credit, unlike a deduction, is a dollar-for-dollar reduction of your tax liability. So unlike a deduction just reduces my taxable income, and so whatever my tax rate is, that's the percentage I'm saving. With a credit, I'm offsetting every dollar of credit with a dollar of tax.
Now back to tactics and back to timing.
Right.
Okay, you can't really store credits. You've got to get something where you create a credit in the year that you do anything. So there's a federal level of tax credits and there's a state level. The federal level is shrinking for what you can do, short of putting solar panels on a house that makes sense and other things that used to be available for real estate. That category is still possible, but that requires research on a year in and year out basis of what's possible that fits into your plans. The most exciting piece of the tax credit is not at the federal level, it's the state level. And this is where people have, and I'm telling you, every professional I've ever talked to about this, they really don't take a look state by state of what's available in a particular state that can allow them tactical and good timing on creating an offset on taxation. Because if you do a Roth conversion, for example, not in the state of Illinois currently, okay, you would pay income taxes on that conversion at the state income tax level. Stay tuned for what Illinois might do with that one. Small comment, all right? But you want to counteract the state income taxes in addition to the federal income taxes. So in the state of Indiana, for example, where I have a house in Valparaiso, okay, there's a thing called a scholarship granting organization. And what happens is if you contribute to a scholarship granting organization, typically you're able to take half the federal deduction, but the organization will grant you 50 cents on a dollar in a state income tax credit. Now, I can play with that all day long. I can stuff a big, huge wad of money in a donor advised fund, take a federal deduction to the extent that I know I can based on advice. And all of a sudden, I've got a whole bunch of state income tax credit because I can grant a big chunk of the money out of that donor advised fund to a scholarship granting organization to counteract the taxes on the Roth conversion. Now, you can apply the same concept beyond the Roth conversion. You could take a look at selling a business, selling off an investment portfolio, selling real estate, and remember I mentioned earlier in this session about marrying a donor advised fund where you can take a tax deduction that has less limitations. Okay, with the charitable trust, which does have some limitations based on how you what we call fund the trust. This is a third component that would be fun to play with, that would allow you to turn around and be able to say, I played with the right numbers to be able to create everything. A good federal reduction in taxes due to deductions, credits. Oh, and by the way, we have the state income tax credit we've layered in. You run all those things just into numbers to see what happens in the future for what happens with your wealth picture, whether you think you're sacrificing or not. Typically speaking, it's got to work out where you can see without instant gratification, you are far better off for you and your family during your lifetime. And of course, with the right type of planning with your three collaborators, including somebody on this video who's not to be named, but you know already, they would love nothing better to be able to go to the next generation and do all kinds of cool stuff from what you've done, because there is an estate tax benefit for what you do in some of these strategies in this particular bucket, which has all these three categories within a bucket.
Yeah, and that's why it's good also, again, with that number crunching, when we look at not just saving taxes for the current client, but when we talk about enhancing their wealth, it is also their ability to pass along on a more tax efficient basis assets to the next generation.
I was almost tempted in the beginning of this video to talk about starting with you dying. Well, folks out there or clients of you who are dead, I don't think that gets any excitement going. But the fringe benefit, like you've alluded to, you have more options to play with. In fact, you create some estate tax savings because some of these strategies to begin with, obviously, simple, you put money in a donor advised fund, it's not your theoretical money anymore. I say that tongue in cheek, but the bottom line is it's not part of your taxable estate. So whatever you dump in there, and you're gonna have a reduction in estate taxes, much less all the extra after-tax wealth you're going to leave to your family. Yeah. So those are all the nuances. This is why it's so critically important to talk through ahead of time. And I don't mean 12 months. I don't mean that, in January 1st of the year following you did something or it happened to you. This is a 10, 15, 20 year, educate me, keep me up to speed with what I can still do, and be framed in such a way that you can quickly implement. I've had work with some folks in the past with professionals who have created a shell charitable trust that's really not funded except for a small amount of money. So all they've got to do is make a contribution to the charitable trust, which is much easier than having an attorney find a way to squeeze in time to get the trust established. So there's all kinds of things. You can have a donor advised fund you can create with a smaller amount of money, and then you can automatically just make a contribution. So the more you can do to logistically do all this stuff, much less anticipate over a longer period of time, the easier it is for your collaborative team to be able to turn around and do cool stuff to help you and your family both during your lifetime and beyond.
Yeah, wonderful. Well, thank you, Mike, for this illuminating discussion about what we mean by tax shelters and how to think of your assets and investments through kind of, I think, this as a really unique tax lens. And I think the point you make frequently, right, which is meet with your advisors, run some numbers, look at your particular situation, and find the solution that works for you.
I would say one final thought. Make sure that the planning tool that you're going to be utilizing can take into consideration all the things I've just mentioned. In the perfect world, you'd be able to do a projection of what your income tax liability would look like with or without some of these strategies as it applies to your wealth. So it's not like a tax software where CPAs have a way to look 1 to 3 to 5 years or 10 years in the future and can't apply it to what's going on with the rest of your wealth. Okay, it's critically important that you've got the tool and then let the brain power of your team, come up with really cool stuff based on some of these strategies we've discussed in this video.
Yeah, wonderful. Well, thanks so much for joining me. And everyone, please make sure you come back and watch our final video when we talk about trust as a tax category. And then Mike and I will also be doing some videos where we talk about particular examples of where clients have used the tax shelter category to move assets from one other tax category, maybe taxable to tax exempt, or maybe from tax qualified, tax deferred to income tax free.
Well, it's interesting enough, we're going to tantalize you. People pay a lot of attention to storytelling. There's all kinds of cool stories, and you might say, oh my gosh, that's exactly my set of circumstances. And you might find that hits you more than these videos. And so we're hoping that we could storytell examples and that we could get that people would respond to, and maybe even professional advisors, not-for-profits would go, oh, wow. I think that's, again, The more people are educated on this, the more they've got the tools to work with, and the more they can build up experience, or even from a professional perspective, they can enable and help clients. The charities can help clients and get benefits out of it themselves. And last but not least, the client/donor gets benefits from it too.
Yeah, wonderful. Thank you, Mike.
Thank you, everybody. Appreciate the time.